All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I wanted to do something a little bit different on video here today. Something, typically I'll give you my thoughts and opinions on different things, but I'm not just going to give you my thoughts and opinions. I'm going to go out and just talk about the bearish case here and, kind of what its implications are. And some of these thoughts and, some of the things that I'll share, I subscribe to. Others I don't, but I do want to show you the full case here, with things. But let's go out and let's take an uber bearish view of this market. Let's just kind of take this kind of grumpy Gus bearish view of everything's about to go to hell in a handbasket, and let's just go see if it holds any water. Right. Well, let's just go see if it holds, any real water, and let's take a look at it on a couple fronts. Let's take a look at it on a earnings front. Okay, we'll take a look at it on an earnings front. We'll take a look at it on an economic data front, and then we'll take a look at it on a technical front. Right. So we'll take a look at these three areas here, and again, we won't explore them 100%, but we'll kind of go out and delve into them just a little bit. Let's come here to FactSet. You see me pull this up a lot. FactSet Earnings Insight does a great job of aggregating a lot of the metrics for earnings season. There are other aggregations out there, but they do a pretty darn good job. Key metrics, earnings scoreboard with 66% of the companies, reporting so far this quarter. 71% of the companies have reported positive earnings per share surprises. 62% have reported a positive revenue surprise. Okay, there's no context, so it doesn't mean anything, right? Is 71% good? Is 62% good, right? But we do know that earnings surprises are greater than revenue surprises, and yeah, that has been the case, right? Here we go for Q1. 53 S&P 500 companies have issued negative earnings per share guidance, and 12 S&P 5 companies have issued positive earnings per share guidance. I mean, on the surface, that sounds pretty ugly, right? A lot more companies giving negative guidance versus positive guidance. But again, no real context, right? And if we add context to them, which we can do here, as we go through it, we can see what things look like. And I'm looking for, let's see here, S&P 5 companies, S&P 500 companies. So this is comparing companies with international growth versus U.S. domestic growth. And you come in and look at a lot of this. But percentage of companies beating earnings per share estimates, 71%, is equal to the 5-year average. So there, we have context for that, right? We're pretty much average, right? But the earnings surprise percentage is 4%, which is below the 5-year average. Okay, all right. Now, the 5-year average here is 4.8%, so it's not huge. It's not tremendously below. Here's the revenue. Percentage of company beating revenue estimates is above the 5-year average. 5-year average is 60%, right? It's 60%. The revenue surprise is 1.2% above the 5-year average. So, we're looking at a market where, in general, the earnings so far, they've been pretty decent. Right, they've been pretty darn decent. In fact, in some regards, pretty positive. Where's the bearish case in this? Right, where's the bearish case in this earnings? Well, one of the big bearish cases in this is the energy sector. There's a big part of this number increase that comes out of this energy sector. Where the growth on this, this is the largest earnings growth in a while for the group, and it's not hard to grow when you've had such bad numbers, and so we're seeing a lot of that really kind of come into the numbers right now, and so the bears are going to look at the earnings season and go, wait a minute, okay, energy, this is this is one of the spots that's skewing things. But if you look at the industrials, you look at the rest of the sectors, it's pretty darn bullish. It is very difficult to make an uber bearish case when you look at what the earnings are. When you look at just what they absolutely are right here and right now, it is very difficult to make a bearish case. But when you come to look at the futures, more S&P 500 companies issuing negative guidance, right? What is this? What does this look like? I mean, are we, is there more negative guidance out there than normal? Well, at this point in time, 65 companies in the index have issued earnings per share guidance for Q1 2119. Of these 65 companies, 53 have issued negative EPS guidance and 12 has issued positive. The percentage of companies issuing negative EPS guidance is 82%, which is above the 5-year average of 71%. So basically, what do we get from this? Well, we know that generally there are more companies that have a negative EPS guidance than a positive EPS guidance. That's the norm, right? Even in the most bullish of cases and the most bullish of markets. But in this market right now, we are seeing more negative guidance than what there has been here in a while. That's about the bearish case. That is pretty much the case that they can make, here with it, that, hey, you know what, the future is going to be bad, right? And, fine, they could be right, but what do we know? When a bearish case is being made or a bullish case is being made because of what's going to happen in the future, we know that takes some catalyst and that drives momentum elements in the market. What drives the long-term trends are what the actual numbers are. And the actual numbers this earnings season, there's not a huge bearish case to be made. If you want to come in, take a closer look at a lot of these, you're welcome to. With 2/3 of the companies having reported, we still have a bunch of companies set to report, but it's not going to change the percentages. It's not going to change the statistics in a huge way here. But you can come down, you can see where a lot of the earnings growth is. It's in energy, right? Healthcare, financials, real estate, information technology, materials, utilities, consumer staples, they're all below the growth rate for the market, right? Consumer discretionary, industrials, communication, and, the big leader, energy, is the one that's kind of creating a little bit of a skew here with it. So you can kind of see what the bearish case is there for it. But bulls are going to look. They're going to look and say, hey, you know what? Profit margins, they're up. So our revenues are up. Profit margins are up. It's one where the bulls have a lot of case to be made when it comes to earnings. Now, what about economic data? Right? What about economic data? Well, really interesting, because when you listen to the Fed, right, and you listen to the Fed in November and December, and they started changing their tune, but November and December, they were real staunch, and the economy's growing, the economy's great, grand, wonderful, we have this and this, it justifies rate hikes and all of that, right? And then the market, dipped and dipped, and as the market dipped and as it got to those lows in December, the Fed starts changing their tune. Hey, you know what? Maybe there's some risk factors out there that we need to price in, that we need to kind of take a look at. And, what happened? Well, the market went, oh, okay, thank you, Fed, for finally acknowledging the risk factors. But then this week, the Fed has done something a little bit different. The Fed has said, the markets are up. Okay, the economy must be doing great, and we have Powell out there and other Fed members out there saying, hey, things are great, grand, and wonderful, and off they go, and then the economy is fantastic, and really kind of blowing the same story they did back in November. And, the market's buying it. But it really kind of feels like the Fed is playing stock market, right? Where, they're acknowledging risk when the market are down, and when the market's up, they're, lauding the economic growth. And, ultimately, if you believe, hey, stock market always gets it right, you say, oh, well, the Fed, of course they're going to follow the stock market. But that's what they're doing right now. Now, if we go look at, if we go look at some of the data, right? Institute of Supply Management. I just want to come into the ISM data because, for me, this is one of the pieces of data that has a much broader implication for what all the rest of the data is doing than, something like a jobs report or something like that. But if we look at the the February ISM number that came out, and we look at the actual number, right? It came in at 56.6, so it was better than December. Showing a little bit of uptick. New orders ticked back up. Production ticked back up. Overall, most areas ticked on back up. And that was a big shift and big change that we saw. We had been seeing erosion, and we got a tick back up here in the month of January. Now, this is something where, is this a one-off? We always will see in data that starts to turn, we'll always see, some one-offs there. But, are we talking about the trend shifting, or are we talking about some one-off type of data? Well, let's come in and we'll just take a look at the U.S. here, and I'm at a site called Trading Economics, and we'll come into the manufacturing PMI number, and let's just go over the past 5 years, and here you kind of see what it looks like. The manufacturing PMI numbers have had, we saw this downtick that happened middle last year, a little rebound up. The markets, U.S. equity markets, breathed on this. They went and hit new highs on this. And the PMI data comes on back down. Now we've seen an uptick, and we see U.S. equity markets breathing. But are we talking about a new downward trend starting to emerge here, or are we talking about just a one-off type of situation? And this is one where the bears are going to say, look, there's a general erosion. The 12-month average of the PMI data is coming on down. And, the bears will have a decent argument. But we're far from going below 50. And what's the key of 50? Well, above 50 is expansion. Below 50 is contraction. And so, we can go through long periods of time with the ISM data falling, but still in an expansive mode. The market's going to be a little choppy, sure. But overall, there's a general positive implication still. They don't go into a contraction phase. And, even the best bearish argument right now, for the ISM data is, to say, hey, you know what, it's just going to get worse in the future. Well, what's that sound like in terms of the earnings, right? It's just going to get worse in the future, which is very easy for the bears to say. Is there anything in this data that suggests it here so far? Well, not yet. Not yet, right? There really isn't. What about consumer confidence? There's one that market participants will look at, bears will look at, and they'll go, hey, look at this drop in consumer confidence. Do they have something here? Yeah, they do. They do. Right? Bulls are going to say, well, this is just a stock market gauge, and, consumers saw the market go down, so, the confidence ticked down. And the confidence will tick right back up when, the consumers see that the market's back up. And there's a valid point there, but this is one area where we are seeing erosion come in to the markets. Sorry, I didn't mean to click on that one. But you can come in and take a look at, any of these points. And the bottom line is, regardless of the data point that we pull up, that we come into, the reality is that we're going to see about the same thing. We're going to see some slight erosion, like on the ISM number, or like on the consumer confidence number. We're going to see slight erosion, but we're not seeing contraction. So the growth rates, we're talking about a Ferrari going down the road. It's going down the road at 20 miles an hour, and it's decelerating down to 15 miles an hour. That's what we're talking about. that generally is not a high growth, a high, big market booming type of environment, but it also tends not to be a big market dropping environment either. One of the areas that can be oftentimes kind of a warning sign, if markets are ready to really turn or we're ready to go into some sort of recession type action, is consumer credit and the consumer credit change. And we have seen consumer credit start to come on down. It has not been as expansive. It's had a little bit of a downtick here. But if we go back and we look at it historically, you can see that during this bull market run, we haven't had big drops in consumer credit. We had the one that happened there in 2015, and that was kind of a one-off for a few measures, a few reasons. We had the little pop right here when there was some Fed action back in 2010. But overall, we have seen that we have not seen the action we saw in 2007, 2008, where consumer credit was going below zero, where the change was going below zero. And so, it's just one of those where, the bears across the board, when it comes to the data, they can say, yes, the data is slowing, but they can't make an argument that the data is contracting. And that puts them in between a rock and a hard spot, here with that. So, it's kind of a similar story to earnings, except for the fact that earnings are growing. It's just there's some worries about future potentially contracting. The data is contracting, but the data is slowing, but it's not contracting. So what about the technical environment? Right. I mean, what about the charting? The market internals. Type of environment. Well, we've talked about this, quite a bit in the last few days. Right. I mean, the bullish percent index here. I mean, it's still there's not a 6% pullback. When there's a 6% pullback, yeah, there will be a bearish sell-off. Right. If you're looking and saying, well, at this level, that level, well, pull up the bullish percent index. Pulls back 6%. Yeah, you're not going to hit the top of a pullback, but you know what? Pullback's on. A pullback is on. But so far, doesn't suggest it. Now, is it overbought on a historical context? Oh, you betcha. You betcha. It is incredibly overbought on a historical context. In fact, one of the things that I like to do here with it, let me get the log scale off of this. Let's get the indicators off of this. We'll just put an RSI on here, which is kind of a overbought, oversold indication. And I'm going to do an RSI 28 days. So go out a little longer, not as short term. But when the RSI on the bullish percent index gets below 30, this RSI 28 below 30, it's pretty oversold. It is very oversold. When it gets above 70, it's extremely overbought. And it's just starting to get above 70 here. And, you can see it can stay overbought or oversold for, substantial periods of time. But we are starting to see it get into that, overbought state here with the bullish percent index. And the last time it was in the overbought state was January of last year. Ahead of, a sizable market pullback. And we're talking about the bullish percent index being in a similar spot right now. So what's the bearish argument here? The bearish argument's overbought, right? Bearish argument's overbought. And for almost every single technical element out there, that's the bearish argument. The bearish argument is overbought. The bearish argument is overextended, right? We look at the number of stocks trading above the 7-day moving average. 408, it's 80%. That's not, what I would call extremely overextended, but that is pretty heavy. That is pretty heavy. The number of stocks trading above the 20-day moving average, right, here in the S&P is up here over 80%. That's a pretty big number. And are they technically overbought? They sure are, right? They sure are. Is there any sign of weakness here just yet coming into play? There's not. right? There's just absolutely not. And so, it's another one of those, hey, you know what, overextended, but, no real signs of weakness here just yet. Let's go take a look at small caps. Let's come in here to, we'll pull up a performance, and we'll take a look at, how small caps have performed relative to large caps over the last 30 days. Well, we have small caps outperforming just fractionally. This is one area that's not overbought. Generally, when we're talking about a really overextended area, we're talking about, small caps outperforming by over 5% over a 30-day period. And we just simply haven't seen that, right? We'll also be talking about emerging markets outperforming in a big way. But actually, emerging markets in the last 30 days, they're lagging the S&P by 3%. They're actually in a little bit of a bearish ratio. And bears can point to this and say, hey, you know what? This is typically what we see ahead of a downturn in U.S. equity markets. You look at transportation. Transportation's been outperforming. The bulls are going to look at this and say, hey, this is a huge advantage for the bulls, but it's not quite overbought either. It's only a 3% differential, which is a very healthy differential, here for the bulls. So, the bears just don't have a whole lot here, right? They just don't have a heck of a whole lot, to sink their teeth into when it comes to the market internals. And nothing about any of this is changing today, right? We're not talking about things that change hour to hour, minute to minute, day to day. This isn't something that, yesterday was one thing and now today it's different, or Monday was one thing and today it's different. The bearish case is the same as what it has been for about the last month. It's overbought. That's what the bears have. It's overbought and things are going to get bad in the future. Is that a great case? Is that a slam dunk? No, not at all. In no way, shape, or form. Now, all you have to do is go to a news site any given morning, right? Go to like MarketWatch or something like that, and you are going to see that there are some very prominent individuals, very prominent firms making strongly bullish calls or strongly bearish calls. Some of them using the same exact reasoning. Which is, yes. Anyway, but it's going to be out there. And some of these are very influential. Some of these are very intelligent. Some of these are firms and people who have called big moves in the past, who have been right in big ways in the past. And there's a lot of calling. There's a lot of calling right now. But so far, in terms of the metrics and everything that we've seen, there's not a great case for the bears, right? Now you say, well, Jeff, you have some puts for the challenge, and you're right, I do, right? My view of the market, when I start to look at some things, there are some things that don't make a heck of a lot of sense to me, and I could be dead wrong, and ultimately maybe proven wrong, but I don't think so. And I do think there is a substantial pullback in the cards here. Is there any sign that it's happening right here, right now? No, there's not. Right? Am I willing to add more? No. And my position on puts remains the same. If you're going to have some puts, you better get some time, right? Because it may not pay off right away. And I want some more puts, right? But I'm stuck sitting on my hands because I don't have, some of the technical arguments here for things, just yet. I do think the upside is overall limited, but at the same time, there's some catalysts out there that could easily change that, and change that in a fast and a very very abrupt type of way. But you look and the market drops 30 points tomorrow. You look at some of the panic that will ensue, some of the selling that will jump in. I think it will be substantial. I think it will be fast. I think it will be very, very quick. And I'm worried that I may may not have, I may not be able to get in time. It may be an overnight type of thing, and I may not be able to get in. So I'm willing to, be in. Yes, I have some loss right here. I don't think I'm going to end with a loss, though. I think ultimately I'll be able to be able to pull some gains there, but I'm not willing to add more yet to try to magnify those gains. I still have to kind of be a little bit cautious because the bottom line is the bearish case just simply isn't strong in any one of the three major arenas: the market internals, which include the technicals, the economic data, and the earnings. What does that say for the bulls? Well, that tells you the bulls have a pretty good case, right? They absolutely have a pretty good case. Now, there's a difference between a bull market environment and something that's going to stay bullish and continue to go bullish and have another, huge percentage to the upside, which is the part that I personally look at, and I don't see a ton of upside, here in the market during the month of February, March. But these tend to be some more bullish time periods overall. So have to take that into account here as well. But anyway, that's the bearish case out there in the market. As you're looking at things, as you're setting things up, keep that in mind. There's some real nice bright spots out there. One of the areas I'm very interested in, and I've talked to you about my personal exposure, and it's one of its lowest periods. My upside personal exposure in the markets is probably lower than it's been probably since I started Trader Minute back in 2013. It is very low. And it got lower today. This morning around the open, I sold my Twilio. But I'm extremely bullish on Twilio. But overall, Twilio reported earnings. And they reported a 77% increase in revenue, which is a monster number. Absolutely monster number. But Twilio did something that we saw Amazon do back in 2014 and 2015. And let me show you Amazon back in that time period. Let's go back here. Let's go 1600. Let's see if that'll show it. Yeah. But here's Amazon back in 2014, 2015, kind of stuck in the mud. It's kind of stuck in the mud. In fact, on earnings, a lot of these big sharp drops, they were on earnings. And Amazon, every earnings period, was coming out and saying, look at our Amazon Web Services. Look at the revenue growth that we're seeing here. It's monster. We're talking about absolutely incredible revenue growth. And the analyst and investors said, yeah, but look at everything you're spending to get that. Bezos come out, of course we got to spend to get it. But we don't have to spend permanently. Ultimately, these are going to stack big earnings into our bottom line. And ultimately, they started to do it. And they started to show it. And Amazon Web Services became the big growth driver for Amazon in 2016, 2017, 2018. Twilio right now, this earnings report, kind of something very, very similar. Very similar. Yeah, we had monster revenue growth. And you know what? The revenue growth is going to turn into earnings going forward. But yeah, we spent a lot to get there. And we see this happen with companies. And it's always worth some downside. It's always worth some sell-off. And in the case of Twilio, it could be worth 25 to 35% in terms of sell-off. That's spend fear. But ultimately after that sell-off, we will see Twilio come back and hit new highs. We will see investors jump back in after this kind of, you spent too much sell-off that takes place here with the stock. And I do think that is the case. I think that is, what we are absolutely seeing when it comes to Twilio and the earnings reaction. And, this it kind of had an interesting pre-market reaction, was down big, rallied back, went green, and then, really kind of started to sell off as the market opened. And, as it had, as investors started to digest it a little bit more. I still think it's one of those cases where if you're not playing stock market and you hold Twilio, you have a multi-year time horizon. Twilio is one of the best stocks out there. But if you're looking for a little short-term pullback, it definitely is in the cards here when it comes to Twilio. And when it comes to this type of stock, it can be very hard. It can be a pretty big pullback. I mean, it can. Now these are things where it can pull back 30% and it not look like all that much. There with it. Okay. Thanks for hopping on. Have yourselves a great one. We'll talk to you later. Take care.